Mark Eppli is the at the Graaskamp Center of Real Estate at UW-Madison. He's been there about 4 years, I want to say. I actually remember Mr. Graaskamp, that's how old I am, from the 80s and 70s, but he's preceded him, and that individual had quite a name for himself. But Mark is going to speak about real estate, which is one of the areas that we have had on our list for a couple of years to get a speaker on. So I think we've got one of the preeminent speakers. He's published a few books on the topic. His school is number 2 in the nation, actually first public school. Wharton is the first. So that's a private school. He's a Fond du Lac native, and so in some respects, this is a trip back home, back to the Valley. Although, are you driving back through Fond du Lac on the way home, or?
I did on the way up here.
You did on the way up, okay. But it's going to be an interesting presentation. One other thing that I think is interest to all of us, he's on the board of the Federal Home Loan Bank in Chicago. And that kind of affects all of us, has to do with the background on how rates are set and some of those kind of things in this business. But without further ado, I'd like to welcome Mark Eppli from UW-Madison.
Great. Okay. Gentlemen, am I live? Are we good? Okay. Well, first off, it's fun coming home. It's fun coming back to the Fox River Valley. All good on the AV stuff? Great, thanks. Yeah, I did grow up in Fond du Lac, went to Goodrich High School, and got all my degrees down at Wisconsin. And delighted that I can share some of this back with you. Delighted to be back at my alma mater, which is the University of Wisconsin. So a handful of you might know some of the presentations I do. And the way I do this is I jam a lot of slides into a fairly narrow amount of time. So I'll have a presentation of 35, maybe 40 minutes. So if you have questions, get them out, and we get them through, I think you can put them on your chat if you are remote. So go to the chat little bubble and type it in, and we'll share it here, or here, just raise your hand. It's kind of fun presenting live again. I do this kind of thing kind of nationally. In the last year, I was, before COVID, I think I went to 8 or 10 different cities nationally, and now I'm back home. And it's the first time in more than a year, so delighted to be here. When it comes to my presentations, like I say, I've got a lot of stuff in a short period of time, but please get some questions put together. So let's start with a fairly dense first slide. And I think we need to start with this first slide in this way, because let's talk about the COVID recession. So most recessions begin with some sort of a interest rate event of some sort, or financial market stress, which interest rates go up, undercutting the economy, slowing it down, and creating a vicious cycle downward, right? When we start looking at the COVID recession, it should be much more like some sort of a national disaster, where you have a reduction in supply and demand, but then you come out of it pretty quickly when it goes away. Well, COVID hasn't gone away. That's one of the problems. We've got some of the worst COVID infection rates right now. And so it'll be a V-shape, but not quite. And we'll talk a little bit more about that. When we start looking at the federal stimulus, that's money provided by Congress, what that does is it makes that V-shape more steep, okay? And so we'll take some time and look at that. And then the next thing we want to look at is when you start looking at what is the impact of the Federal Reserve. The impact of the Federal Reserve is really on investments as we go into the future. And one of the things that they've said is we're going to keep rates low for a while. So it's going to keep things going. So it's not going to be that quick need to do something. There'll be greater confidence. So once we work through this, I think we'll have a really solid and robust recovery. Let's start by going through some of the COVID material, as well as a little bit about politics, and then I'll get more narrowly into kind of the commercial real estate and how some of this applies to commercial real estate. For some of you who've been at my presentation in the past, I've kind of separated the national macroeconomic from the more real estate. Here I've integrated a little bit more, but let's start right with the coronavirus cases. You can start to see they're peaking, not going away. Once these start going down, the economy will come back. And they aren't going down. But we do have the vaccine, which we're all familiar with. Let's go on and take a look at this. If you were to go back even before October of 2020, October 25th, 2020, you'll see that it was heavily focused on the East Coast, New York City in particular. Then it actually shifted to where we were the problem. And then you look at where we are today, red is bad, and you can start to see the bad is throughout the country, okay? So let's look at, hey, now, this is kind of an interesting little slide. You know, a COVID relief or COVID super spreader, but I couldn't help but include this slide, but you go, this is the ratio of bars to grocery stores, and you can bet the ratio being high towards bars is brown, and you can make out the state of Wisconsin in this, can't you? So there you go. I think it's kind of fun and a little bit of humor, not that there's a whole lot of humor around the COVID pandemic. When we start looking at this reemergence of COVID or third spike, whatever number spike you want to call it, we started seeing, this is some really interesting data from Castle Systems. They're the security people for office buildings. And they collect how many people are actually in their offices. And you can start to see before the COVID pandemic, we were at 90+%. It dropped right off, started coming back, and it's tailing off again. That the reemergence of COVID is really hurting us in some of these cities. Not that they're going back to a lockdown, but certainly slowing down quite a bit. And then I said I was going to include a little bit about politics. And by the way, one of the things I will do is that throughout my discussion, I will likely talk about politics. I'm not trying to convert you to be a Republican or a Democrat, but I do want to give you a sense of what some of those policies do from an economic perspective. When we start looking at, and I thought it'd be helpful to share some of this, especially since we've got an inauguration tomorrow. If we go back over the last 8 administrations, Republican, Democrat, you'll start to see that on average, the Democratic administrations have greater growth than the Republican ones. And I am leaving off the Trump administration, A, because it's got the COVID impact, and B, we don't have a complete set of data from that. But in all likelihood, the policies of Trump don't end tomorrow. They will probably end or start tailing off a year from then. And I said, let's actually lag this data by 1 year. I don't know if it's a year or 9 months, but let's take a look at it. What you'll start to see is, whether it's Democrat or Republican, we end up having similar growth. Some of you might look at the stock market today and go, geez, that's nuts, that stock market's going up. Well, what the stock market's doing is looking out 9 months to a year, and they're pretty positive where we're going to be in 9 months to a year. The week of the election, when it was likely that it was going to be Biden, the stock markets went up nicely. And when we had in Georgia, when they had the runoff down there, and that went to the Democrats, went up again. Is that because people like Democrats better than Republicans? No, it's all about the economics. There's an expectation that there'll be greater stimulus coming into the marketplace, helping out the markets sooner rather than later. From an economic perspective, I agree with that. I think it's going to help out the markets sooner, but in the long term, I think it all works out in the wash. I don't think it's better to be Democrat or Republican, but this gives you some actual data to look at from the Federal Reserve. So let's get into real estate. It's my understanding most of you with FEI here have some connection with real estate in some way. And when you look at the core valuation metric with real estate, it's called the cap rate, right? NOI divided by cap rate equals value. So it's your expected net operating income divided by some sort of perpetuity expected rate of return gives us value. That's how we value real estate. Of course, you can spread it out on a 10-year discounted cash flow analysis, but it comes back in many ways to something like this. From there, though, let's start looking at real estate value. It's really a function of the local real estate property market. So what is NOI? That's Main Street. That's urban economics. That's what happens right here in Neenah, okay? When we start looking at, and by the way, property markets go by the different property types. You got office, industrial, apartments, hotels, retail. Those are the 5 main food groups. And then you divide it by the real estate capital markets or financial markets. And that's your cap rate. And when you really look at capital, can flow easily across borders and across cities and across countries. And that really is looking at how does real estate returns compare to those of the broader marketplace. So we look at it, urban economics divided by financial economics equals value. Now, when we start looking at this, I've taken it one step further and I said fiscal stimulus divided by monetary stimulus gives us value as well. So what we're really seeing here from a background perspective is what's happening in Congress is helping people afford their monthly rent payments, helping businesses make their debt service payments and continue their businesses. That's the fiscal stimulus. The monetary stimulus is what the Federal Reserve is looking at. Let's go on. Let's look at the fiscal stimulus, and we'll start by looking at impacts on income, employment, business, as well as consumption. I've got a couple of different categories here. So why is this important? Who cares? What I've put up here in front of you is we really look at property income growth, NOI growth, and I map it up with GDP growth. I don't do any legs on this. And you can start to see, you don't need to be an economist to see that, generally speaking, when GDP is growing, NOI grows. And it follows pretty closely. There's a couple of things worth noting in here. Certainly the real estate growth is a bit noisier, but we can start looking at this. Maybe I can point, I'm not sure. Take a chance. No. Oh, we don't want to do that, do we? I think Michelle just lost a heartbeat. Let's go to 1991 here. You see there's a V with the orange line. That's GDP growth. It went into a recession, V-shaped recession. We came out of that pretty quickly. But you'll note that the real estate NOI growth lagged it a little bit. Then if we go over to 2001, when we had the 9/11, we kind of have a V again, and the real estate growth lagged it there as well. We then go over to the Great Recession, same thing we can look at today. What's important about this slide is to show the relationship, one, and show there's likely a lag, two, there's still some pain in the real estate income streams that we haven't quite seen yet, okay? And that's the purpose of this. Let's go on. From there, I pull some data from the Federal Reserve, and then I kind of summarize it up top. What we have in the background here is the deficit, or the debt, I should say, the federal debt as a percent of GDP. And you'll see it jumps here, and that's really the COVID spending. And if you want to get some numbers from that, the total debt is about $27 trillion. Now, the astute members of the audience will say, yeah, but I looked at today's Wall Street Journal, it said 21, Eppli, are you exaggerating here a little bit? The Wall Street Journal report doesn't include the funding of Social Security, which helps fund this. This is the total debt. This does come from the Federal Reserve economic data. So from there, you can look at, that's about $81,000 per person. That should start to concern us. Although the interest rates are low, so we can grow our way out of this at the current time. But if you look at the bottom three, deficit spending is $4.3 trillion. That's like almost a quarter of our economy, okay? 20% anyway, a little better than 20%. And you go 4.3 Eppli, where'd you get that number? Well, 2.2 in the original CARES Act. We had a structural deficit of about 1.2 above that. Now we're at 3.5. We had some CARES Act add-ons for the PPP program, about $400 billion, a few other things. Next thing you know, you're north of $4 trillion. That's a really big number, and you can see what it looks like on the graph, and this graph goes back to 1990. And just in the last year alone, what we've seen is the deficit spending per capita is about $13,000. So I have a family of four, that's $50,000 of deficit that's added effectively on my balance sheet through the federal government. So we should try to think of it in that way. And by the way, I think what they did as far as the CARES Act, great stuff, it was needed. And we'll talk about why in a little bit, okay? So I think what Congress is a great thing. The follow-on, I'm not quite as confident of. Let's go on. So how did this really impact personal income and consumer spending? And what you have here is a trend. And so for the most part, if you add up all of personal income, adjust for some depreciation, that really becomes GDP. Personal income equals GDP. And you can start to see this is a really solid track going right up, and then it really goes up, and that's the CARES Act money flowing into the system. You can see it's tailed off a little bit. We're almost reverting to the trend line. Okay, so we had this big pop of additional income. But what happened to consumer spending is it should have gone up as well, but it did not. We all kind of pulled in a little bit, right? And what we saw, and looking now to the right-hand panel of this, is you can start to see that durable and non-durable goods largely stayed the course. Dipped for a month, maybe two, stayed the course. What we saw is a dramatic drop in services. And since February through November, we have $1.5 trillion more in savings that we had relative to the previous year. So you can start to see those big blue lines up there, that's savings. Savings equals not growing GDP currently. Hopefully it'll be future GDP growth, okay? So what we have here is, if there's a takeaway, we have some growth that we can get out of the stimulus that hasn't been spent yet. And one of the ways you can look at whether or not it's been spent is to look at checking account balances. So if you go over here to the left side of the panel, you go, here are checking account balances by quartile. So at one point, maybe all of you maintained your jobs, and you'd expect your checking account balances to grow because you can't go out and maybe go on a vacation or go on as many dinners that you might have had before. But what you'll start to see here is for the lowest and the second and the third quartile, checking account balances are up 40 to 50%. So what happened was we had some of that CARES Act that worked its way through the system, and most folks are in pretty good shape. And I'll call it 85% versus 15%. 85% of us are in pretty good shape. I really don't think we need another $1,000 or $2,000 check written to everybody. I think that simply increases our deficit. But what we do need to do is make sure we really take care of that other 15% who are unemployed and who are really having a hard time. That's where I'd focus it. And if I had a Biden's ear, I'd say, that's what we need to focus this on. The rest of us are actually doing okay, at least during COVID. But let's look at a longer period of time, and let's look at net worth. The net worth of families in the United States is $123 trillion. It's truly a stunning number. $123 trillion. The bottom 50% of households in the United States is up there in blue. And you go, Eppli, there's no blue up there. Oh, there's blue up there. It's only 2.3 trillion of it. So I share this when it starts to look at multifamily and single-family housing development. You go, when it comes to the transference of wealth from the older generation to the next generation or the younger generation coming in, that bottom half has almost no net worth. And that's half. That's not like the bottom 10% or 20% or 30%. It's half. Okay? So when we start looking at multifamily, you go, it's going to be harder to get out and buy that home and get that and accumulate that down payment. And that way, when you start looking at this single-family rental is an interesting possibility, or some of the more suburban, higher quality a multifamily. But this is kind of a stunning slide when you start looking at where the bottom 50% is. And you can see what the next 50 or 49% is, as well as the top 1%. By the way, if you go all the way back to about 1900, we're back to almost the Gilded Age as far as the concentration of wealth. Okay? I share that as well because when you start thinking about some of these riots, when you start thinking what's happening out there, it could be as much about income inequality as it is about anything else. And I would say on both ends of some of these protests that we've seen on both the right and the left. So let's look at fiscal stimulus and employment impacts. When we start looking at that, let's start at the big number here. We've got the past 7 economic downturns. A couple things worth noting here. The last 2 took us a long time to get out of. We really had a slow trip back. When we looked at 2008, though, that was a financial crisis, and those do take longer. Okay? When we start looking at what we have in 2020, there's your classic V. We went down, we're coming back, but COVID's not gone. Okay? So let's go to the next slide and start looking at how many of these current jobs are temporarily lost. In other words, people expect to go back to the employer versus what might be more permanent, okay? So I'm going to start on the right-hand side of this panel and look at temporary versus permanent. What you can start to see is some of those temporary, and temporary might be, let's see some of the workers here. I guess to say they're not fully staffed right now. They don't need to be, okay? Because we're not having conferences, we're not having weddings in the same way, among other things. What we'll see about 4 million of those jobs, we hope, come back. Although what's happening is some of the temporary are becoming more permanent as this wears on. when we start looking at this as well, we can start to see that the economic downturn is impacting racial minorities more so than the white population, and oftentimes because many of those service jobs are held by those groups. And then from there you go, the reduction in employment is really hurting some of the smaller single outlet type retailers and businesses. So going to the far right again, let's look at that unemployment rate, and we'll go to the next slide and we'll look at it by industry. And we look at it by industry, leisure and hospitality and other services. So what we're seeing is we've lost about 10 million jobs February to where we are in November, right? So we lost more than that, and many have come back, but we're still out about 9.6 million jobs. And what we have is those top two, which is about 3.8 million jobs in services and leisure and hospitality, are likely to come back. But when we start looking at the rest of these are more likely to be slow to come back. And hence that Nike swoosh when it comes back to our economic recovery. We'll get the stuff pretty quickly, and I think we'll see another kink up once the vaccines take hold and when we start in the fall. But then it'll take a while to get everything back. It'll take us to probably 2022 late in the year, maybe 2023 to really get back to where we were pre-COVID. This is a stunningly positive slide, both United States and globally. It goes to the Institute of Supply Managers. And what they have here is any number above 50 means you're expanding. Anything less, you're contracting. You see both the United States as well as the other big economic powers all being very positive about manufacturing. And that being up here in the upper part of the state, the flow over of manufacturing is really important to other businesses as well. So you get one or two of these jobs, you get 2 or 4 of the other jobs that support them. Let's go on, final area of fiscal stimulus. And let's talk about consumer spending impacts. So Amazon. Amazon is really on the left-hand side of this exhibit. Couple of things worth noting. Up until COVID, what you're starting to see here is almost all retail growth wasn't happening in stores. The growth actually was going to the internet. And what we saw was a big spike during the Great Recession. So we went from, what do we have here, about 12% to about 15%, maybe back down to 14.5%. Here's what's important about that. The other 85% is happening in brick and mortar. Brick and mortar isn't going away quite that easily. It's got some challenges, but it's not going away. So I think this is worth taking a look at. And I think in the future, you'll start to see that continued, any sort of real growth in retail sales will be going more online. So that trend line isn't positive, but we still need brick and mortar outlets. And here we actually have, you can see how some of the food and services industries are really hurting in today's world. And then you go, let's look at housing. You go, son of a gun, look at those light-colored things. Once again, the Midwest just can't get a break. Then you go, hold on. Take a look a little closer now. What is the green? The light color. Actually means they've seen year-over-year appreciation in single-family prices of greater than 9%. So actually, that's the case for the state of Wisconsin. They just came out with their most recent numbers. They're in double digits, low double digits, about 11%. Year-over-year growth in single-family house prices. And so what you're starting to see here is actually those light-colored ones in the middle part of the country, we're seeing better appreciation than most other parts of the country. In part, what's happening is we're leaving some of these cities to go to smaller cities, and that's really even a little bit of that movement from San Francisco, New York, and Chicago, and as they move to places like Boise, Idaho, and Maine, in Montana, it really pushes those prices quite a bit higher. Okay? But don't count the big cities out. And I say don't count the big cities out for a couple of reasons. The first one is I start looking at my graduates at the University of Wisconsin or at Marquette University in a day gone by. Where do they want to be? They want to go to the big cities. They want to be in Chicago. They want to spend those first 4 years in Chicago, and then they may stay there, but they may not. And so And I think that's the case for all the Big Ten schools as well as the Big East schools, among others. They don't, it's hard to get talent right out of the University of Wisconsin to go up to Marshfield. Okay? So let's take a look at why I think cities will survive the COVID crisis quite well. And it's for two reasons. One, cities are places of consumption, and two, they're places of production and innovation. So places of consumption, we go there for sports, for theater, for music. We go there for food, and many of the food opportunities we don't have elsewhere. And we also go there for the young adults to find a partner. From there, when we start looking at cities as places of production and innovation, I just want to know how So let's start with the very first number. It comes from Ed Glazer. It's in The Triumph of the City, his book we use in our urban economics class. And in the larger metropolitan areas are 50% more productive than the smaller metropolitan areas in the United States. And you go, well, how can that be? Well, it's not simply just being in the city. You might have more educated people there. But what you end up having is you end up having firms clustering in those bigger cities, and then some of the best talent follows those firms, and more likely today, the kids want to be in those cities, and the firms follow the kids. Let's take a look more specifically at Amazon's HQ2. So Amazon went out, they had 238 proposals nationwide to be the second headquarters outside of Seattle. They were in 54, I think it was, different states and metropolitan areas and territories. And where'd they end up? They end up in New York and Washington, D.C., two of the most expensive cities out there. Why? Because they already have other firms there that have talented individuals. They already have other talented individuals there as well. And so they can mix it up, and that's where the talent goes, is to some of those bigger cities. They didn't go to some of the smaller ones, okay? And that just gives you one quick example. Finally, this idea of innovation. I want to go off on many tangents right now. It's part of what I do. But I'm fighting it. Just around the idea of how difficult it is to innovate, and how difficult it is to innovate over Zoom. You don't have this one-off connection, and you don't learn from each other in that way. It's a very, very different experience. Now, some of those things can go off and be taken care of on Zoom, but not easily from an innovation perspective. Okay, so those are the fiscal things. Those are the things that we would really focus on when it comes to the property's NOI. Okay, let's now look at the property's cap rate and start looking at some of the monetary stimulus. And let's start with this slide right here. It's a little messy, but let me explain it. So first off, let's just look at the overall, the filled-in area in talk about that first. So what we have here is the Federal Reserve's balance sheet. Prior to the Great Recession, they had about $1 trillion of assets on their balance sheet. Then, in 2008, quantitative easing, QE1, 2010, QE2, 2012, 13, QE3, okay? So as we saw their balance sheet grow from about $1 trillion to $4 trillion, growing by about $3 trillion. And it started to roll off actually a little bit in the last year and a half, 2 years. And look at December 19. And what it took us almost 5 years with the Great Recession, we deployed a similar amount of capital, or the Federal Reserve bought securities, which pushes out capital into the marketplace, pushing down interest rates in the matter of 2 months. And you go, is that overkill? Let me give you a quick example. John, when he introduced me, said I'm on the board of the Federal Home Loan Bank of Chicago. On March 16th, that was a Monday, we started getting sense, because on about March 13th, we got a sense that COVID was going to be a big problem. We started meeting with the risk committee. I'm on the risk committee as well. We started meeting every day. And by Tuesday, one of our member banks said, you won't believe it. I mean, and it was confirmed by others. I just had a customer go up to the drive-through window and took out $10,000 in cash. And he says, I know this customer. He wasn't using it for nefarious purposes. He was worried. Next day, we get from the institutional side, from the Federal Home Loan Bank, that U.S. Treasury securities, short-term, often considered cash in and of itself, were trading at 2.5% to 3% discounts. That's a 1.5 to 2 years worth of return. And they said, I'll forego it. I don't want a Treasury security. I want cash. Normally, it's not 250 or 300 basis points, it's 8. Maybe 9 basis points is what the spread is on those. So there was a panic going on. That's how later in the week. It's Friday now. The third largest trading platform, Finestra, got hacked. And on Friday, and they're one of our, they do some of our trades for us, we were literally writing out our trades by hand. And I'm going, oh my God. On Monday, we're going back to the Great Recession. It was one of those things where it gives me goosebumps right now. And the markets opened Monday and Tuesday and Wednesday, and what happened? Absolutely nothing. There was so much capital being infused. The Federal Reserve saw this problem and addressed it. Institutions are important, and this gives us a great sense of it. Without that, we were going right down the same illiquidity or the liquidity trap that we had back with the Great Recession. It was real. It was happening. It didn't happen. So this is great. They liquefied the whole asset base. Now, it's great to a point because now they've got all this money is sloshing around like it's in a great big bathtub. We've got to manage that too because that can spark inflation. Now, let's look at the other thing I have on this slide, which is interest rates. These are 10-year long-term interest rates. It's what we're interested with real estate because we generally invest for a long holding period. And if you can start to see, it's imperfect, though. When we had QE1, what happened to interest rates? They dropped dramatically. Then they kind of came back. QE2, they dropped. QE3, they kind of dropped. And you can see the bottom fell out with the most recent asset purchases that the Federal Reserve did. You'll also notice the gray on the top at the very right was also they were starting to buy corporate securities as well, usually through like Vanguard type funds. But so you can start to see this interest rate that we have now that went down to about 60 basis points, 70 basis points, now closer to 110. It's artificial, okay? It's not real, but it's where we are today. And they said we're going to keep short-term rates low, but the long-term rates I'm not so sure. And they can do that with the buying and selling of long-term dated securities. Now let's go on. Let's get right to the real estate and start getting your questions ready. I've got about another 7-8 minutes and we'll go right to you. So let's take a look at this one. This one's a little bit messy as well. And let's start with the orange line. The orange line is once again 10-year treasuries. So now when we start looking at 10-year treasuries, it's somewhat important because if I'm going to go buy a piece of real estate, I'm going to get 60, 70, 80% of that's going to be debt. And if my debt rate goes up, I can't pay as much, which therefore my cap rate goes up. Let's look at this relationship a little bit. We'll start to see here that 10-year treasuries since 1990 have really come down quite nicely and are likely to stay about 2%. We'll see that on the subsequent slide. From there, you can start to see in blue, those are the NACREIF, that's National Council of Real Estate Investment Fiduciaries, large pool of owned real estate. You see the cap rates were close to 9% for a better part of the 90s and then came down to about 5% most recently. What's interesting here, though, is the premium or the risk premium between the two, and that's in gray. And you'll start to see this risk premium. It started to get a little bit skinny during the recession of the 1990s. Actually, almost went negative for a little bit, and then it popped back up. The spread, the risk, we were overpricing. It's called an asset bubble, right? We don't think there's much risk with real estate. You look at the Great Recession, you go, what are the risk premiums there? They were almost non-existent, maybe 1%. Now, on average, by the way, if you do a line across, it's about 2.6, 2.8%. Where are we today, though? And I share this with you because are we in an asset bubble? Should we be scared? Is this kind of nuts right now? What we have now are some of the greatest spreads we've seen. No, that's artificial, though. I told you that with the previous slide. But even if you were to take treasuries from the 1.1% they are today and take it into 2 or 2.5%, what you'll then still have is a normal risk spread for real estate relative to the risk-free rate, which is the 10-year treasury, okay? So I share this slide to give you a sense that I don't see it as a bubble at the current time. Let's take a look at what the Fed has to say and where we've been from a GDP perspective. So what we have is the trend line. The trend line is from the Congressional Budget Office. They more or less expect the economy to grow at 2.1, 2.2, 2.3% over the last decade. What we saw is it didn't grow like that, and then it grew at about 2.4, 2.5%, and actually went above trend level, and you can start to see now we've got the downturn that we're familiar with. This gives you a sense of where we've been. Let's talk about what the Fed is thinking about, and I pulled this right from their report, their summary of economic projections. And so first off, what you have on the top line is their expected GDP growth, and then their September projection. So this was from their December data. And what's interesting about September is to say, how have they changed their mind or adjusted their data in the last 3 months? And you'll start to see that for 21, 22, and 23, they said the first couple of years we're expecting greater growth than before, and then it's going to moderate close to about 1.8%. The unemployment rate, quicker job growth, lower unemployment rates more quickly, okay? Inflation, they don't expect inflation to get to 2%. Not CPI, not PCE. It's a personal consumption expenditure growth. And then you go, here's their short-term rates, and they expect to keep them at 0, short-term rates. And once again, they can mess around with long-term rates with the buying and selling of longer-dated securities. So what I think is important to see here is two things. First off, the Fed has been revising their number upward and upward as far as how quickly they think things will happen. That's a good thing. One of the longer-term things, when you go the longer-run view, in the past, CBOE and the Fed expected our economy to grow at 2.1, 2.2, 2.3%. That's not going to happen anymore. We have fewer immigration. We have pretty slow birth rates here. We're likely to see fewer people entering the job market, being productive, and growing GDP. So that's a little slower number that we're seeing longer term, and I would tend to concur when I look at demographics. Let's look, so as I started, I said, let's look at fiscal stimulus, monetary stimulus. Let's more closely look at real estate now. Let's look at the real estate capital markets first. Debt and equity. This is dry powder coming from private equity investment, about 3/4 of investments in real estate, private equity. It's not stepping back. We have a new private equity program at the University of Wisconsin, and we're actually looking at any number of private placement memorandums. We've got to partner with CLA as well. Thank you, Ken and others. And we have the students actually got live private placement memorandums, and they're closing out after they get to the street in a day or two. There's a lot of money chasing these. There's no shortage of equity capital, certainly not from the private equity side. When we start looking at that, you go, what has that done to cap rates? And you might have heard about a K-shaped recovery, where some parts of the economy will do well and others won't, and so it won't necessarily be a V or anything else. And I generally agree with that for all the reasons you might expect. But we also have a K-shaped recovery for real estate in all likelihood. And let's look at it from a cap rate perspective. What we're seeing here is the top line is hotel, the middle two are retail and office, and the light blue trending down is industrial, and the orange is, on the bottom, is multifamily. And as we'll see on the next slide, when I give you the details behind this, I'm not sure we've hit what we call price discovery for 3 of the property types. That would be office, hotel, and retail. We've had a real decline in transaction volume. But what we're actually seeing is from banks to investors to developers, all focusing their energy on 2 property types. And that's multifamily and industrial. And that's actually pushing cap rates down in a time of a recession. And by the way, we don't really have a recession because it's really 2 quarters of negative growth. We only have 1 quarter of negative growth. But if you look at what's happened in England, and it's pretty reflective of what we've had, this is the worst productivity downturn in 300 years, what they've had in England. So I'm kind of comfortable calling it a recession, even though definitionally it might not be that. But what we're seeing is right in the current downturn, we're actually seeing cap rates go down on these 2 property types. It gives you a sense of how money isn't necessarily running away. When we, I guess it's a couple slides later. Let's look at this, though, from a capital markets perspective. It's really important that we see both debt and equity capital flowing into the marketplace. And we are seeing a tightening of sources of debt into the marketplace, with the exception of Freddie and Fannie. You see the light blue line on top. Freddie and Fannie are keeping a lot of liquidity in that multifamily market. And when we look at some of these other bank loans and so forth, they're really heavily focused on one property type, and that is industrial, and, well, multifamily as well. Here I give you 2 different sets of information. One are standards, and the other is demand. So anything above a 0 means standards are loosening, and demand is going up. Anything below 0 means the opposite. What we're seeing is a tightening on the way we've set it up here. And what we're seeing right now is a tightening of bank loans at this point. They're not running away from it. And one of the things that's really interesting about JP Morgan's announcements of their profits on Thursday or Friday of last week, what did they say? They had the highest profits ever. And they're actually going to reduce some of their reserves. And you go, whoa, right now, bad time, and they're reducing their reserves. That gives you a sense of how confident they are in the economy coming back, and on the fact that they have got plenty of loss reserves set aside. The banks aren't running out of town. They're kind of slowing down to see what the situation is, but they're not pulling up stakes and leaving like they did in 2008 and 2009. Let's look at newly troubled loans. So this is data from Real Capital Analytics. Jim Costello came to the center and presented. And we start looking at it. You can see the troubled loans were in all different property types in 8, 9, 10, 11. And we come out here to 2020 second quarter. And what do we have? It's 2 property types, retail and lodging. If you look at the rest, and a little bit with the dark blue is office, but the others are almost a rounding error. So once again, there's going to be some pain in those property types. They'll have to figure that out, but it's not universal pain that we're going to see. Finally, let's go to the property markets, and I'll wrap this up in another 3 or 4 minutes. Transaction volume. Here I give you the transaction volume, each by property type, colored. The bottom is multifamily, and the yellow is industrial. You'll start to see that back in the Great Recession, transaction volumes went to 7-8% of what it was the previous year. What we're seeing here, and what you see on the next slide, is volumes are down 57%, but they're not going away. So we're not seeing a complete drying up of the deal flow. I think that it'll be really hard to find some great opportunistic buys out there, maybe a little less so in multifamily and lodging. This gives you a sense of where the year-over-year changes in volume are. As I mentioned earlier, industrial and apartments are in pretty good shape. The others are all off a fair bit. And they're still looking for price discovery. Really, what are cap rates on those properties? Look at values. Since the Great Recession, since the COVID recession, and you start to see apartments and industrial have actually done better. Their income streams aren't that much better, but the cap rates have come down, creating price appreciation. Office sits in the middle, and the other 2, lodging and retail, are hurting a little bit. I think some of the office has got some pretty big challenges in front of it for 2 reasons. The work from home will create a bit of a challenge. Getting people back into the office will create a bit of a challenge as far as how much office space do we really need. But I think this next slide is every bit as important as well. When you start looking at the big institutional buyers, they're over-allocated to office. That doesn't mean they're going to run away from office. If you looked at the same slide for 2000, I actually had it up here for a bit, but I thought, nah, it's just too much information. But the allocation of office was 42%. So looking to shrink it a little bit, what I'm suggesting here is it's the market, the purchase market for office is going to be weak. Both, I would argue, for downtown as well as a suburban type space. And because of that, office will look more like retail and lodging than multifamily and industrial. This is interesting and really helpful for places like Milwaukee and Appleton and Neenah. It doesn't quite look like that at first, but RCA collects data, and they have their MM6. Those are the big 6 metropolitan areas in the United States: Boston, Chicago, New York, San Francisco, and LA, and I missed one. But when you start looking at it, over the last 1 to 3 years, the non-major metro areas have done far better than those major metropolitan areas as far as price growth. So it's a little bit of that pushing out into cities like Nashville and maybe like Milwaukee and here as well, as people are realizing, gee, you know, and they had a really interesting piece in Saturday's Wall Street Journal about moving out of San Francisco. It's just a little crazy to try to stay. So final slide, and then we'll go to some questions. So let's try to summarize this. You know, it's hard to make some really definitive projections, and I'm usually that way. What I actually do for groups that I regularly present to, I said, what did I say last year and how off was I? Was I too optimistic? Was I too pessimistic? And actually, that's where I start, because then I get a sense. This time around, it's a little harder to do that, and to give you hard numbers it seems less meaningful. Let's try to get the direction right, more so this time around. So first off, when we start looking at the COVID recession, it should be a lot like a V-shaped, but it's going to be moderated. And so we're going to have some slow growth out of that moderation, okay? And some of the suggestions, look at the 90 or 95% economy. We're going to come back and we're just going to operate at 95%. But it isn't going to be all industries do equally well or not well. From there, one of the things you start thinking about is which are cyclical behaviors and which are structural. I talked about, are cities really going to go away? I go, no. There's still beacons of productivity, beacons of consumerism. People will come back to them. A little bit like 9/11. You go after 9/11, people don't want to go in tall buildings, right? Made sense. But then we've reinforced the cockpit doors. We have metal detectors for those tall buildings. And guess what? 18 months later, they weren't thinking about 9/11 almost. I think we have a fairly short memory here in the United States. We'll go back to what we're doing pretty quickly. This impact is far bigger and impacting us more directly. I get it, but it's still the same thing. Hey, I got the vaccine. Not yet. Hopefully I will. I think I'm, 1C as a teacher? But I'll go out and do that, and I'll be good, and next year, in the fall, everybody that comes to Wisconsin may have to have a vaccine or something like that. Guess what? That concern goes away. Let's go from there. GDP. It's going to struggle in the first 2 quarters because of how bad COVID is right now, period. But from there, I think what we have, I showed you how checking account balances are high, savings are high. These firms have PPP loans that they didn't use. And so they're ready to go with some of that. So I think what we're seeing is we'll be actually quite solid. The second half will rock. But that said, there will be some hot pockets of inflation, which could spook the Fed a little bit as far as that whole bond buying. And don't write off big metropolitan areas. When we come to real estate, industrial and multifamily will continue to have low cap rates, but also continue to give you low rates of return because there isn't as much risk there. But from there, when you start looking at it, opportunities will come. Hospitality is going to come roaring back, but you got to get the timing right. And then finally, office and retail. Those could be some great opportunities, but I would ask you to really think about who is the next tenant going to be. I'm not talking about hypothetically. I want a name. I want to know who will be that next tenant who would take that space, and same with office, who is going to buy that building at the end of the year when you want to sell it. So that's what I'd ask you to really think about, who is the next user, who is the next buyer of that space. That's everything I have. John, should I hand it back to you? You're back in the back, I think.
Yeah,
I got some questions. Or do I hand it to Michelle?
Am I on? I have
thank you.
I have a few questions already, Mark. First question is, what is the general employment level for the state of Wisconsin last year? Do you have a sense on that?
Yeah, actually, I could have done it. What I had prior here, too, is I had year over year by county, every single county in Wisconsin, and what we had was 57 of our 72 counties before the Great Recession had unemployment rates of under 3%. That's just crazy low. That's almost unsustainably low. It goes to we're not getting new talent. We're not great at attracting new talent. What we've seen is a step up in unemployment, and I can get you that data, but it's far less than the nation as a whole, and I think we'll spring back quite nicely, probably better than the federal at the federal level as well. So I think we're at about mid 5%, and we'll quickly get down to something under 5 by mid-year next year, or by later this year, I should say.
Yeah, right. Thank you. Another question. I was surprised to see the real estate price increase greater for Wisconsin than for Texas. All the articles discuss the move to Texas. Your thoughts?
Yeah, first off, there's a big move to Texas in almost any city in Texas, be it Dallas, Fort Worth, Austin, San Antonio, Houston. They're all growing pretty quickly. One of the things we have in the state of Wisconsin, and I've done some research on this, is between 1991 and 2007, in the state of Wisconsin, we had an average number of new lots of 14,500. Since the Great Recession, we've had 3,500. We have an inadequate number of new lots to provide new housing, and our home ownership rate in the state of Wisconsin is going down, down, down. When the national level, it's coming right back up again. We don't have enough completed lots. A couple of reasons things that might explain that is, first off, we have no national builders to come in here and provide long-term funding for that. And then the second is banks, when the regulators came in 2008 and 2009, they looked at every single land loan, because those were the ones that created the greatest losses, and none of the banks want to play in that space anymore. I would say it's probably that. As much as anything. We really have, if you look at the data that just came out today from the realtors, we have a 2.1 month inventory of homes, supply of homes. In a normal period, it would be about 5 or 5.5 months. The appreciation rate will continue here like crazy into the future because we have no supply to purchase.
Thank you. I have a question now. Are office buildings dead with this COVID effect and the work from home? I mean, do you think it's going to come back? Or what are your thoughts in general on that? We're all in this room and our membership are wondering, what do we do with our office space? Is it survivable? Talk to about that.
Yeah, office buildings. So there's any number of studies out there that at first suggest that, gee, if I can take some of my workers, pre-COVID, if I can take some of my workers and let them work remotely, that's a good thing, and because I can save on my office costs. And if the savings on the office costs offset the lack of productivity from those folks working at home, it's a win. So they go out and do that, and what happens 6 months, 9 months, a year later? Not only do they save the office costs, but the workers are more productive at home. That's a problem to office buildings. However, then they start talking to those people that went and worked from home for 6 months to a year, and guess what? They don't want to do that anymore. They're kind of going, I'm feeling a little lonely. I'm feeling a little isolated. There's also this fear of missing out. What's happening back at the office? I think also what we're going to see is firms can do this for short periods of time, 6 months, 9 months, but when it comes to innovating, in doing new things, it's hard to do that online. I think we'll see the people come back. I think the challenge could be for the more suburban office, and most of the offices here in the Fox River Valley are that, as you go, do you really need to be in an office innovating? Or are you really in an office doing more of a task? And I'll use call center as an example. It could be something more than, but you go, no, you can do that from home, provided that you've got the bandwidth and provided you can do that from home. You don't have kids or you have babysitters. But that said, I think it could hurt that a little bit. But when it comes to a lot of other office users, they need to be back in the office.
Great, thank you. We want to do some polling questions now. And so you want to launch that now, Michelle?
Should we take one more? Can we take one more question? Do we have time
Well, one
for
more,
one more?
sure. Here.
Yeah, hit it, Jay.
Hey, Mark, if you believe that markets seek equilibrium, you believe markets seek equilibrium, and again, markets are rational over time, I agree, they're not rational right now. But if you look at the large cities and you look at where we're at today, there has to be some type of shift coming in population as a result of this pandemic. I think the pandemic is going to cause a real marked change in the way that we do things. I think population density may decrease in some of the largest cities, again, just to guess. If that happens, who are the losers and who stands to gain the most as a result of shifts in population and workforce and what might be coming?
Yeah, so I think embedded in that were a couple of questions. I think the first one was around just the movement and then what's going to happen to the big cities. Did I get that right? I'm sorry.
You did.
So what we're seeing right now, a couple of quick examples. So had a mortgage banker who does over $5 billion in business come to class and present to the private equity class. And we're talking about what is the hot product. And we actually had a suburban multifamily. And what he started looking at is corridor versus non-corridor multifamily in suburban Chicago. And the non-corridor, where you could pull up into a garage and go right into your unit, no free rent, month and a half free rent over here. So your idea of shift is definitely there. And that's a COVID shift. But I would argue that COVID shift isn't going to go away. Because what's going to happen is millennials will not easily be able to buy a house, but they'll want something similar to it, something more like a townhouse, something more like single family rental. And they will migrate to that more on a suburban and more in less dense areas. I think we did see a bit of a disruption going into the second part of your question. So that gives you a sense. So yes, I think getting away from some of that is going to happen. I still say the fear of missing out is going to really drive some back. So right now, the idea of going into a tube called a train to work, going up in an elevator, another tube, and then sitting into, you go, man, that's just COVID everywhere. And you go, but we'll quickly get over that once we get to that herd immunity. And the excitement about being in some of these places will drive some of that back. I think we'll have some really difficult time driving convention business like this. I think some of this will happen online much more. I think we're more comfortable with that. And some of the costs of business travel will be difficult. The density of cities, I think some of our biggest cities will really struggle for more than a couple of years, more than 2 or 3 years. The New York, the San Francisco's, the Boston, in all likelihood, because there will be a continued fear, certainly among some portion of the population. I'm not sure I've fully answered your question, but hopefully I addressed it in some manner. John, back to you. Are we any other questions, or are we on to polling questions?
We have more questions.
Oh, let's do more questions then. Hang on. No, that's fine. Okay, sorry, hold on here, Mark. You mentioned companies have difficulty innovating over Zoom, but many organizations have been able to prove they can successfully work remotely. Do you have a perspective on how this gets reconciled post-COVID? What does the 2022 office environment look and feel like, and how will that impact the office real estate market?
Yeah, great question. So I'll stand pretty firmly behind the idea of innovation occurs. And let me use the Status Center that was built at MIT. So the Status Center is kind of a building, but it also links to a couple of other buildings. And what they have is it's a Frank Gehry design building. If you know Frank Gehry with his big swooping designs, has a lot of internal spaces that are nooks and crannies. And they started realizing that there's some really good serendipitous meetings when I say, I was thinking about you the other day and we were working on something and all of a sudden you've got this serendipitous meeting. So they started putting high top tables with a couple of chairs there. You don't get that on Zoom. And I think what we're living on is the innovation that happened pre-Zoom right now. We're going to see a real drop in innovation as we go along and as this goes longer. I think that piece is really important. Those people need to be back in the office. Now, the question is, how do they get back in the office? And what does that start looking like? We can do work from home. It used to be, work from home. Vacation from home, yeah? Well, that was kind of the sense. That's not the sense anymore. People are working from home and are productive from home, as we mentioned earlier. However, what's going to happen is they will work from home a couple of days a week, but also work from the office a couple of days a week. And so what will then the demand for space be? I'd like to think it's probably going to decline some due to the work from home. Now, I think we have about 5 or 6% of the employees in the United States that really work from home. And some might suggest that might double to 10%, which is a pretty big jump. But I don't think it'll be much bigger than that. It's not so easy. So I've got a daughter who works for Deloitte down in Chicago, and she had a studio. Does she want to work from home? Well, she comes up to Wisconsin where she can work from home from parents' house. But that doesn't work so well. And it doesn't work so well for a lot of folks. Maybe the folks in this room, but a lot of places it doesn't work so well anywhere from distractions among other things. So I think there will be, there's a lot of uncertainty around that. It's still a wild card. And here's the really big challenge for office is how the hell are you going to pay for the capital improvements and what will that next space look like? And that's the cost of that can be just ruinous to an income pro forma. And that's a real wild card in this COVID environment.
Great answer. Thank you. A couple more. Is there going to be an impact because of the non-evict rules to owners of rental properties?
From the non-what?
The non-eviction rules for rentals or owners of rental properties. So it's right now you can't kick people out. They aren't paying their rent. What's going to happen? What's the outfall from that?
So let's start at the higher end of that. And if those of you who are interested in some of the eviction versus in rent payment, go to the National Multifamily Housing Council Rent Payment Tracker. So Rent Payment Tracker, NMHC. And you'll find that year over year, payment rates, rent payment rates are off about 1.5%, maybe 2% this month versus this month a year ago. And it's been that way each of the months going on. That's across about 11.5 million units. Now, those are the nicer units, though. So they're not seeing the hit. So we'll start with that. When you start going to the very bottom end of the marketplace, that's a different story. That is a story of folks not being really able to make some of their payments, and they get to stay in that unit. That can create some real hardship if you've got units that are generally smaller mom and pop. Also had the opportunity to talk to some of the folks out in LA. And LA they said, well, let's have rent eviction, a moratorium, and gee, let's make it for commercial as well. And I'll shorten the story because it's actually a pretty good story. It's on Beverly Hills, it's this and that, guy in Ferrari, hedge fund manager, hasn't made his rent payment for each of the last 6 months. Why? Because he can. He has that option. He can't get evicted. And when this is all over, I'll pay you. But I'm not going to pay you before then. So there is some bad behavior that can come from that. There's also some behavior that's desperate behavior. And hopefully those folks will be, there'll be some compassion in that process. But yes, that could be a problem, especially at the lower end of the market. Higher end, we're not seeing the impact. You saw the checking account balances? People still have money in their checking account.
I have one more then. So selfishly, I work for a company that is continually looking in new markets for industrial warehouse property. What's going on with that? What is it, that seemed to be kind of in the middle of the road of all your slides. Is that going to be impacted by any of the things you've talked about in terms of rates? And maybe I would also ask, should we enter into long-term rentals or should we do something shorter?
A good question. So one of the challenges that that market has is it has been, especially the big warehouse space, it has been so dominated by one company called Amazon. And it's not simply the 1.1 million square foot big distribution center, but they also have the smaller last mile distribution centers in last 5 miles, whatever you want to call it, but last mile. So they've been really scooping up a lot. And then you got Walmart kind of following in suit and so forth. So there's been tremendous demand for that space. These developers are putting this up, are actually selling the properties oftentimes even before it's leased because the person who's buying it thinks they get even a higher rent than what the developer thought. It's kind of crazy like that, and it is still like that, by the way, right up to today. What we're seeing is, generally speaking, nationally, we can absorb about 60 million, 62 million square feet a quarter of industrial. Industrial is largely concrete tilt, and go up pretty quickly. You still have to get the approvals and all the other stuff, but you can add the space pretty quickly with that. What we're starting to see is in the final quarters of this year, it's likely to be closer to 100 million square feet of space coming out of the ground instead of 60 to 65. Here's the problem. They went with 60 to 65, all of it got leased up. So I don't know what the real rate is there, but 100 sounds like a whole lot to me. So to answer your question, I think we're in quite a strong industrial market as far as buying and investing. As far as signing a lease and going with a longer term lease, I need to know a little more information. Maybe we can talk about that because it could cut either way. There's a lot of people who are really fearing the rollover of the Amazon leases, and are they going to renew? And so if they start putting that stuff back on the market and doing something different over here, then you've got a better rate in the future. Well, I think that's it for me. Do I hand it back to you, John, with some polling questions?
Questions are done now. I think we're good. I think, thank you, Mark.
Thank
we
you,
really
and thank you for
appreciate
the
it.
audience here. It's like I say, first time in a year that I've been alive. So, and thank you virtually as well, and thank you for the tech folks for the support.
Thanks.
Good night.